For 2025, a powerful federal tax credit is available to your business. This credit could be worth up to $9,600 for a single qualified employee. You may be missing out. Screening all your new hires is the only way to know. Imagine your business with an extra $50,000 in tax savings. We'll break down who qualifies, how to claim it, and the mistakes to avoid. So, what is the Work Opportunity Tax Credit? It's a federal incentive for hiring people who face barriers to employment. It directly reduces your federal tax liability and promotes a more capable workforce by creating opportunities. The program is fully authorized through the end of 2025, meaning every hire you make until then is a potential opportunity. So, who are these target groups? One of the largest is qualified veterans. Another is recipients of SNAP benefits, also known as food stamps, and long-term family assistance recipients who can generate credits for 2 full years. This sounds good, but how do you get the credit? The process is time-sensitive and requires precision. What's the first step? It starts with 2 forms, IRS Form 8850 and ETA Form 9061. Both must be completed on or before the job offer is made. Here is the most important rule. You have just 28 days from the start date to submit these forms. Miss it by 1 day, the credit is forfeited. Why so rigid? The state agency must certify the employee's eligibility before you can claim the credit on your taxes. Missing that deadline is the top reason claims are denied. But what are the other pitfalls that can cost you thousands? Other denials come from simple errors, missing signatures or information, or discovering the employee wasn't actually in a target group. Let's make this real. By hiring a qualified veteran, you could earn a tax credit from $2,400 all the way up to $9,600. That top credit of $9,600 is for hiring a veteran with a service-connected disability who has been unemployed long-term. And this works. Studies show the WOTC program directly increased employment among disabled veterans by about 32,000 jobs per year. It also applies to seasonal work. Hire a qualified youth for a summer job, and you could get a credit up to $1,200. The value is clear, but what about modern work situations? Let's tackle some common what-if scenarios. We asked how you find out if someone qualifies. The answer is Form 8852. You include this voluntary form in every new hire packet. What if your new hire works remotely? It doesn't matter. WOTC eligibility is based on hours and wages, not physical location. Don't work full-time? If they work at least 220 hours, you get a 25% credit. The full 40% credit requires 400 hours. Are you a tax-exempt organization? You can claim the WOTC against payroll taxes, but only for hiring qualified veterans. Finally, the IRS can audit these credits years later. You must keep detailed records, including proof of state certification. Let's connect the 2 most important ideas. First, you must screen every hire. Second, you have a strict 28-day window to act. This combination means WOTC cannot be an afterthought. The only path to success is building it into your standard hiring process. When you do this, OTC stops being a tax chore. It becomes a talent acquisition strategy that lowers your tax bill and broadens your talent pool. The strategy is simple. Screen everyone, submit on time, and keep good records. So, what are your next steps for 2025? Let's review the potential. Up to $9,600 per qualified hire. A significant opportunity waiting in your applicant pool. And the program may become even better. Proposed legislation could increase the credit from 40% to 50% of qualified wages. You have 2 paths. Manage this in-house with trained HR and payroll teams, or partner with a specialized tax consultant. The Work Opportunity Tax Credit is one of the most generous incentives for business owners. Don't leave this money on the table in 2025.